Hey everyone, and welcome to the Deep Dive. Today we're diving headfirst into the world of counterparty credit risk in derivatives trading.
Exciting stuff.
Yeah, it is. We've got some pretty interesting sources to work with today.
Oh, yeah.
A mix of academic excerpts and real-world examples from this book called 2007, Quantitative Analysis, Derivatives Modeling, and Trading Strategies.
Sounds dense.
It is, a bit. But fascinating. Imagine we're on a crazy busy trading floor, billions of dollars flying around.
Makes you sweat a bit just thinking about it.
Right. But beneath all the action, there's this hidden risk that could really make or break a deal.
You're talking about counterparty credit risk.
Exactly. It might not be the first thing you think of when you think of derivatives, but it's huge EE.
It's not about whether the market moves against you.
Right. It's about whether the person you're trading with can actually hold up their end of the bargain.
What if they can't pay up?
Exactly. That's counterparty credit risk in a nutshell.
And it's a particularly big deal with over-the-counter derivatives.
Okay, so let's break that down. What's the difference between OTC derivatives and the ones traded on an exchange? Why does it matter for counterparty risk?
Well, with exchange-traded derivatives, there's a clearinghouse.
Like a middleman.
Yeah, basically. They guarantee the trades.
Yeah.
So even if one party defaults, the clearinghouse steps in to make sure the other party gets paid.
So it's like a safety net.
Exactly.
Yeah.
But with OTC derivatives, you don't have that.
So it's more like a direct agreement between two parties.
Right, which means if your counterparty goes belly up, you're out of luck.
No one to bail you out.
Nope. And our source material actually dives into how this risk can show up in some sneaky ways.
Oh, yeah. Like what?
We'll take a simple interest rate swap.
Okay. Two parties agree to exchange fixed and floating interest payments, right?
Sounds straightforward enough.
Yeah, seems like it.
But what if one party's credit quality starts to deteriorate? Suddenly that vanilla swap turns into what we call a defaultable swap.
So now there's this added risk that you might not get all those future payments.
Exactly. You thought you had a steady stream of income, and now it's looking a bit shaky.
Yikes. That's a good illustration of how this risk can really sneak up on you.
And it goes even further than that.
Yeah.
Our source actually highlights how this risk can even mess with the pricing of credit default swaps.
Wait, CDSs? Those are supposed to protect you against default.
Right. But what happens if the person selling you that protection, the one who's supposed to pay you, if the underlying entity defaults, what if they default themselves?
Oh, wow. Double whammy.
Exactly. It's like buying insurance from a company that's about to go bankrupt.
Not very reassuring.
Not at all. And the source gives some real-world examples of this playing out.
That's what I love about the deep dive. Getting into the nitty-gritty.
Totally. It even talks about how counterparty credit risk can shift the exercise boundaries for options, making them more or less appealing to exercise.
So even seemingly simple decisions become way more complex when you factor in this default risks.
Exactly. You can't just look at the market price. You have to consider the creditworthiness of everyone involved.
This is getting heavy. But okay, so how do we even begin to measure this risk? It seems so slippery and multifaceted.
That's where the financial modeling comes in. These brilliant minds have developed models to try and get a handle on this risk.
Okay, so walk me through it.
Well, they start by looking at two main things. How likely a counterparty is to default, and then if they do default, how much are you likely to lose?
Kind of like assessing the risk of a natural disaster.
Yeah. You want to know how likely it is and how bad the damage could be.
Okay, that makes sense. So is there like a universal model everyone uses, a counterparty credit risk calculator?
I wish it were that simple. There are a bunch of different approaches, and it really depends on the situation.
So no easy answers.
Not in the world of derivatives, but there's this concept called netting agreements that's really important to understand.
Netting agreements?
Yeah, it's like having a running tab with your counterparty instead of settling every single transaction individually.
So if I buy one derivative from you and sell you another, we just net out the difference.
Exactly. Simplifies things, right?
For sure. So that helps reduce the overall exposure.
Exactly. But here's where things get interesting. When a counterparty actually defaults, those netted positions are often treated asymmetrically.
Asymmetrically? What do you mean?
So let's say you're in a net receivable position, meaning the counterparty owes you money.
Got it.
In a default, you might only recover a fraction of what you're owed.
Seriously? Even with a netting agreement in place?
Yeah, sometimes. It's this weird quirk of the market.
So netting is supposed to simplify things, but then the way defaults are handled throws this whole other wrench into the mix.
It definitely adds another layer of complexity. You're not just looking at the net exposure anymore. You have to think about how that exposure might be treated if things go south.
Man, this is highlighting how intricate this whole thing is.
Absolutely. But before we go any further, maybe we should talk about the different types of models used to manage this risk.
All right, let's dive into that. What are the tools of the trade, so to speak?
Well, there are two main categories, micro models and macro models.
Okay, I'm intrigued. Lay it on me. What's the difference?
So those traditional models, the micro ones, they tend to zoom in on individual trades.
Got it. Each transaction on its own.
Exactly. Trying to figure out the potential loss on each specific deal.
Makes sense.
But here's the catch. They can kind of miss the forest for the trees.
They're not seeing the bigger picture.
Right. That's where macro models come in.
Also called portfolio models, right?
Exactly. They take this wider view, looking at the whole portfolio of trades rather than individual transactions.
So they're capturing how all the different positions interact with each other.
Yes. The interconnectedness, the netting agreements, the whole shebang.
Makes sense. If you're dealing with a whole web of trades, looking at each one in isolation is probably not going to cut it.
Totally. And our source points out something really fascinating here.
Oh.
It says that even though those conventional micromodels often use benchmarks like LIBOR for discounting.
LIBOR. That's just a general interest rate, right?
Yeah, it gives you a general sense of borrowing costs between banks, a kind of baseline risk level in the market.
Okay, but how does that relate to specific counterparty credit risk?
Well, the point is, it doesn't always. LIBOR doesn't necessarily reflect the specific creditworthiness of your particular counterparty.
Ah, I see. So it might give you a rough estimate, but it's not going to capture the nuances of dealing with a counterparty that's, let's say, less than stellar.
Exactly. That's why you need these more powerful portfolio-based models, the macro ones.
They can dig into the nitty-gritty, use more specific data about each counterparty.
Right. Credit ratings, spreads, even market-implied probabilities of default.
Wow, so we're talking about some serious number crunching here.
It's not for the faint of heart. But this is how institutions try to get a more accurate handle on counterparty credit risk across their entire book of business.
It's incredible how much depth there is to this concept. We've gone from what seemed like a simple idea to this whole world of complexity.
It's a rabbit hole for sure.
But this is what I love about the deep dive. Unmasking the hidden risks and complexities that most people don't even think about.
I'm with you there. It's all about peeling back the layers and seeing how things really work.
And I'm eager to learn more. We've unmasked this beast, but now I want to know how traders actually wrestle with it on a day-to-day basis. What are the tactics they use to manage this counterparty credit risk in the real world?
And that's a great question, and it's a perfect segue into the next part of our deep dive.
Oh, I'm all ears. This is getting good.
We'll explore the strategies and techniques they use to mitigate counterparty credit risk, from credit enhancement to hedging and everything in between.
Can't wait. All right, so before we went to, I guess, our metaphorical break, whatever that means in a podcast, we were talking about how even LIBOR, which seems like a pretty reliable benchmark,
Yeah, it's been around forever.
doesn't always give you the whole picture when it comes to counterparty credit risk.
It's too broad of a brush,
Right. And all these micromodels focusing on individual trades, they might be missing some crucial connections.
Like we said, can't see the forest for the trees.
Exactly. So now I'm really curious, how do traders actually deal with this in the trenches? What are their tools for managing counterparty risk?
Well, think of it this way. You wouldn't just lend money to anyone without thinking about whether they could pay you back.
Right. Of course not.
Same principle applies to derivatives, just on a way bigger, more complicated scale.
Got it. So let's say I'm a trader, right in the thick of things. What are my options for dealing with this counterparty risk? I know we mentioned credit enhancement and hedging before, but I'm still a bit fuzzy on how those work in practice.
Sure. Well, with credit enhancement, you're basically trying to add layers of protection to minimize your losses if a counterparty does default.
Okay, makes sense. So give me an example.
Collateralization is a big one. You ask the counterparty to put up some assets as security.
Like a down payment on good behavior.
Pretty much. If they default, you can seize that collateral to cover your losses.
Seems pretty straightforward.
It can be. But in reality, it often gets a lot more complicated.
How?
You have to think about what kind of collateral they're putting up, how easy it is to sell if you need to, even the legal framework for actually seizing it.
So even something like collateral, which seems simple at first glance, has all these hidden wrinkles.
Always does. Now, hedging is a whole other ballgame.
Yeah, I was going to ask about that. How does that fit into managing counterparty credit risk?
Well, with hedging, you're basically trying to offset your exposure to a particular risk by taking the opposite position in a different instrument.
So if I'm worried about a counterparty defaulting on a swap, I could buy a credit default swap that pays out if they actually do default.
You got it. You're essentially buying insurance on that possibility.
Shifting the risk to someone else. Clever.
It's a classic strategy. But, and this is important, even hedging has its limits.
Oh, no, really?
Yeah, our source material, this 2007 quantitative analysis book, it actually dives into this.
Okay, what does it say?
Well, it points out that things like value at risk and potential exposure, VAR and PE for short.
Oh, the acronyms. Always with the acronyms.
Right. But they're important concepts. Anyway, the book says that those things, VAR and PE, they can still throw off your hedging strategies.
I'm not familiar with those. Mind breaking those down for me?
Sure thing. So VAR, value at risk, it's a way of trying to figure out the worst case scenario.
Quantifying the potential for disaster.
Exactly. How much money you could lose in a given time period with a certain level of confidence.
Okay, so it's not just about the most likely outcome. It's about understanding the tail risk, the really bad stuff that could happen.
Precisely. And PE, potential exposure, it's all about how much that derivative contract could be worth in the future.
Why does that matter for counterparty risk?
Because the higher the potential exposure, the more you stand to lose if your counterparty can't pay up.
So even if you've hedged your position, unexpected market movements could still blow up your potential exposure and put you at risk.
It's a moving target. And that's why managing this risk is an ongoing process. You know, it's not like you set it and forget it.
Makes sense. You have to constantly be monitoring your exposures, tweaking your hedges, and reassessing how risky your counterparties are.
It's a game of chess where the board keeps changing.
So you're telling me derivatives trading is a bit more dynamic than just plugging numbers into a spreadsheet?
Just a tad. Speaking of dynamic, we should probably talk about this idea of complete versus incomplete markets.
Oh, yeah. This was in our notes. Sounds like we're getting into the theoretical weeds now.
It might seem that way, but it has huge practical implications.
Okay, I'm all ears. Convince me.
So imagine a world where you can perfectly hedge against every financial risk.
Sounds like a fantasy. Like perfectly predicting the weather every single day.
That's a perfect analogy. That's a complete market. Everything is predictable. You can eliminate all uncertainty.
Yeah, I don't think that world exists.
You're right. Especially not in the world of derivatives. It's inherently incomplete, meaning there are always risks you just can't hedge away perfectly.
So it's like trying to predict the weather, but with even more chaos thrown in.
It's messy. And there are a few key things that make the derivatives market so incomplete.
Like what?
Well, one is future volatility. You can't know for sure how much an asset's price is going to jump around in the future.
Volatility is the wild card, always shaking things up.
Exactly. And then there's correlation.
How do those two things relate?
Well, the way different assets move in relation to each other, that can change over time, and you can't always predict how it'll change.
So you might think you've hedged your bets perfectly, but then suddenly the correlation between these two assets shifts, and your hedge doesn't work as well as you thought.
It's a real headache. And this is where the skill of the trader really comes in.
It's not just about the models. It's about human judgment and intuition.
You got it. You have to understand the limitations of hedging, that you can't eliminate all risk.
It's about making decisions in the face of uncertainty.
Exactly. Now, our source talks about this cool technique that dealers use in these messy, incomplete markets.
Intrigued. What is it?
They call it secondary model calibration.
Secondary model calibration.
Yeah. It's basically a way of tweaking the pricing models to account for the fact that you can't perfectly hedge everything away.
So they're building in a margin of safety, a cushion, to protect themselves from those wild cards.
That's a great way to put it. Now let's bring this back to counterparty credit risk. Remember those credit charges and credit benefits we were talking about earlier?
Vaguely. Remind me.
So if you're dealing with a risky counterparty, you're going to charge them a higher price to compensate for that risk.
Right. Makes sense. That's the credit charge.
Right. But if you're the one who's seen as risky, then you'll probably have to pay a lower price.
Wait, really? So I'm being penalized for being risky and they're getting a discount because I'm risky?
It's a two-way street. The other party is factoring in the possibility that you might default, so they're adjusting the price accordingly.
So the credit benefit is the discount the risky party gets.
Exactly. And in an incomplete market where you can't perfectly hedge away all risks, these charges and benefits become even more important.
So it's like this delicate dance of risk and reward constantly being negotiated.
Absolutely. It's all part of the game.
Man, who knew counterparty credit risk could be so multi-layered?
It's a real onion. But that's what makes it so fascinating to study.
It's like we've peeled back the layers of this seemingly simple concept and found a whole universe underneath. But before we wrap up, I have one more question.
I mean,
We've talked a lot about individual trades and how counterparty credit risk affects them, but how does this all play out at the portfolio level? I mean, institutions are dealing with thousands of transactions, all interconnected.
great question. And that's a perfect transition to the final part of our deep dive. We'll explore how those sophisticated portfolio-based models we've been talking about come into play.
The grand finale. I can't wait. We'll be right back after this very short break. All right, welcome back to the deep dive. We've been talking about counterparty credit risk, and it's clear this isn't just about single trades, you know?
It's about the whole system.
Yeah, like all these financial institutions, all these deals, all interconnected. Before the break, we were getting into how traders try to account for the unpredictable stuff, even in those incomplete markets.
Right, that secondary model calibration.
Yeah. But now I'm thinking bigger picture. How do institutions manage this risk across their entire portfolio? Thousands of trades, all those connections.
That's when you bring in the big guns.
Oh.
Those portfolio-based models, the macro models we've mentioned a few times.
Okay, yeah, I remember those. They're the ones that look at the whole forest, right? Not just individual trees.
Precisely. Remember how we talked about the limitations of those micro models, the ones that focus on single trades?
They miss the big picture.
Right. They can't see how all the risks are connected, how one default could trigger a domino effect.
Like a chain reaction.
Exactly. And that's where portfolio models shine.
They help institutions see the whole web of interconnected risks.
Exactly. They can set limits on how much exposure they have to any one counterparty, run stress tests to see what would happen in different scenarios.
Okay, so they're like risk management control panels.
That's a great analogy.
Yeah.
Now, can I get a little technical for a moment?
Absolutely. I love the technical story.
One of the key parts of these portfolio models is what we call exposure modeling.
Exposure modeling.
Yeah, it's all about trying to estimate how much a portfolio of derivatives transactions with a specific counterparty could be worth in the future.
So you're not just looking at the current value, but projecting forward, right? Taking into account market moves, interest rates, all that stuff.
Exactly. And you also have to consider what happens if the contract ends early because of a default.
Ah, right. If a swap is supposed to run for 5 years, but the counterparty defaults after 2, you're not getting the full value.
Exactly. Exposure modeling takes all those scenarios into account.
Trying to get a dynamic picture of the risk over time. Fascinating. What else goes into these portfolio models?
Well, you also have to think about the probability of default.
Right. How likely is it that this counterparty will actually go belly up?
Exactly. And these models use a ton of data to estimate that probability.
Credit ratings, historical data, all that.
Yep. Market implied probabilities too.
It's like building a case, gathering all the clues.
Perfect analogy. And once you have those two pieces, the exposure and the probability of default.
You can start to get a real sense of the counterparty credit risk for the whole portfolio.
Exactly. And then you throw in loss given default, the LGD.
Ah, yes. That's how much you actually expect to lose if a default happens, like estimating the damage after a car crash.
And with a portfolio of derivatives, that damage assessment can get very complicated.
I bet. So these models, they really are essential tools.
They are. They help institutions figure out how much risk they're comfortable taking, test different scenarios, make informed decisions.
Powerful stuff. But are these models perfect? I mean, the derivatives market is constantly changing. New products pop up all the time.
You're right. It's a moving target. And there are definitely challenges.
Like what?
Well, data is a big one.
Yeah.
These models need a ton of data to work properly.
And not just any data, right? It needs to be accurate, reliable, clean.
If you put garbage in, you get garbage out. And then there's the challenge of validating the models themselves.
Making sure they're actually capturing the nuances of this risk, not spitting out misleading numbers.
It's an ongoing process, constantly testing and refining these models.
It's a never-ending quest.
It is, but that's what makes it so exciting.
I have to agree. This has been a truly deep dive. Counterparty credit risk is way more complex than I ever imagined.
It's a rabbit hole.
Yeah.
But an important one. And I think we've managed to shed some light on it today.
We've unmasked the beast, explored its lair, and learned how to navigate its tricky terrain.
And hopefully our listeners have a better understanding of this crucial but often overlooked aspect of the financial world.
Exactly. It's not just for traders and risk managers. Anyone who wants to understand how the financial system really works needs to grasp this concept.
Couldn't have said it better myself.
Well, on that note, I think it's time to wrap up this deep dive. Thanks for joining us. And as always, we encourage you to explore further, dive into the source material yourself, and never stop learning. We'll be back next time with another fascinating deep dive, so stay tuned.